So let's talk about a company you've probably never heard of, but one that's making a massive, high-stakes bet that could totally reshape a key part of the semiconductor world. Today, we are deep diving into Zhenbao Technology, the invisible giant of the industry. And just so you know where we're getting our intel, this whole breakdown is based on some really in-depth institutional reports from the folks over at HDIN Research. Okay, so let's just jump right into the big mystery, the question that really got our attention. How on earth can one single high-tech company be almost twice as profitable as its closest competitor? I mean, in this industry, that's just wild. It points to something really special going on. And this chart, wow, it just lays it all out there, doesn't it? In the first half of fiscal 2025, Zhenbao Technology is sitting on a gross profit margin of nearly 48.5%. Meanwhile, its main rival, Fortune Precision, is down at about 26.5%. That's not just a lead, that's a whole different ballgame. So what is their secret? This really brings us to the core of it all, right? We've got to untangle this 48% margin mystery. Is this a sign of pure business brilliance, or is it a giant red flag that something's not quite right? Well, the answer really starts with their secret weapon. It's a unique business model that completely flips the script. They call it the Direct-to-Fab model. So here's how it works. On the left, you've got the standard way of doing things. Most companies sell their parts to the big equipment makers. But Zhenbao, they're on the right. They completely bypass that middleman and sell their parts directly to the chip factories, the fabs, the places that are actually using them day in and day out. And we're not talking about just any old parts here. They make the critical, high wear and tear parts that are constantly being replaced inside these unbelievably complex machines. You can kind of think of them as the super high-tech razor blades for the semiconductor industry's razors. By going direct, they get to capture all that sweet, high-margin value from the constant replacement cycle. So you might be wondering, does this fancy model actually work? Well, the numbers from fiscal 2025, they pretty much speak for themselves. Revenue just shot up by over 36%. That shows some seriously powerful, direct demand from the market. But here's the real kicker. Their net profit grew even faster, by a staggering 48.7%. That means their profitability is actually scaling even more quickly than their sales. That's the dream, right? So the bottom line is this. Their direct-to-fab strategy isn't just some clever business school trick. No, it's a powerful engine that literally turns their direct market access into the explosive financial growth we're seeing. But this is where it gets really interesting. Zhenbao isn't just sitting back and counting their cash. They're using this success to fund a massive, high-stakes pivot. They're trying to move from just making consumable parts to creating the core technology at the very heart of these machines. They are betting big on the next generation of core components. We're talking about super high-value parts like electrostatic chucks, advanced heaters, and this is a big one, high-purity silicon carbide parts. Those are absolutely essential for the electric vehicle supply chain, which, as you know, is just blowing up. This is a huge move up the food chain. Let's just focus on that Electrostatic Chuck, or ESC, for a second. This is not just another replacement part. It's a mission-critical piece of tech. It's like this super precise, high-tech hand that holds the silicon wafer perfectly still and at the exact right temperature. If they can nail this, it means they've graduated from being just a parts supplier to a core technology provider. It's a huge deal. Of course, this kind of crazy ambition and explosive growth, it doesn't come without some serious risks. So now we've got to flip the coin and look at the other side of the balance sheet, the hidden dangers lurking in the shadows. And the first risk, it's a doozy. Over 71% of Zhenbao's revenue comes from just 5 customers. That is a classic textbook example of customer concentration risk. Basically, if even one of those big clients sneezes, Zhenbao is going to catch a cold. And when you really drill down, the HDN reports flag 3 key areas to worry about. First, financially, the money that clients owe them has almost doubled, which hints at a potential cash flow problem down the road. Second, geopolitically, their biggest customers are the exact kind of companies that are vulnerable to all the international trade drama. And finally, there's just pure execution risk. Their entire future depends on them perfecting brand new tech that just isn't proven at scale yet. And that execution risk, it has a ticking clock. To build all these new products, they've invested in enormous new facilities. Analysts figure that once those are up and running, they're going to add over $10 million in depreciation costs to their books every single year. That's a huge anchor that's going to drag down their profits if these new high-tech products don't start selling and selling fast. So what's the final verdict here? How do you weigh this brilliant business model and incredible growth against such massive risks? Well, let's turn to the analyst's conclusion. You know, the analysts at HDIN Research really boil it all down to one single critical point. Zhenbao's entire high-stakes bet, this whole journey from being a parts processor to a core component supplier, it all hinges on one thing. Can they successfully mass-produce those electrostatic chucks? That right there, that's the ultimate test. Zhenbao Technology is just a fascinating story, isn't it? It's a company trying to make this monumental leap. They've got the strategy, they've got the profits to fund their big dreams, but that execution risk is absolutely immense. So the real question isn't just whether they can keep up these incredible margins, but whether they can totally transform themselves before that clock runs out. To dig deeper into all this, you can find the full reports over at www.hdnresearch.com.